heard it a million times, right? In trading, everyone says, follow the volume. You see a big price move on huge volume, and that's supposed to be the ultimate sign of strength. But what if it's a total myth? Well, today we're grabbing our lab coats and putting that exact idea to the test with data from over 5,000 real-world signals. I mean, just think about it. What if that signal you've been taught to trust, the one that looks so perfect and powerful on your chart, is actually leading you into a trap? That's the exact mystery we're trying to solve today by diving deep into the data behind the scenes. Okay, first things first, let's clearly define the myth we're going after. In the world of technical analysis, especially with candlestick patterns, there's this really common belief that volume is what confirms the price move. It's like the trusty sidekick to the price action hero. So picture a bullish engulfing pattern. You get this big green candle that just completely swallows the previous little red one. The textbook says if that happens on high volume, that's your A+ confirmation. It's time to buy. And honestly, it feels right, doesn't it? More traders jumping in, more conviction. But the real question is, does the data actually agree? Now, this isn't just some theoretical chat. Oh no, we have a massive case file to work with here. We're going to put this idea under the microscope, using real, hard data from the gold market to see if this common wisdom can actually survive a proper investigation. And the scale here is really what matters. We're not talking about a handful of trades. We are digging into 3 years of 15-minute data on gold. That gives us, get this, over 5,300 signals to study. So yeah, this is a deep dive. To do this investigation right, we need the right tools. We can't just eyeball a chart and guess. We need a way to turn this fuzzy idea of confirming volume into something we can actually measure. So let's meet our 2 main forensic tools, which the source material calls Stat7 and Stat7a. So first up is Stat7. The best way to think about this one is like the full, detailed witness testimony. It doesn't just look at the last 2 candles. No, it records the whole sequence of volume changes over several recent candles, giving us all the rich context around the signal. And then we have Stat7a. This is our star detective. It just cuts through all the noise and gets right to the heart of our myth. It asks one simple, direct question. Was the volume on that big green candle higher than the volume on the red candle it engulfed? It's a straight yes or no. And here's why that simple question is so brilliant. It splits our 5,000+ signals almost perfectly in half. About 46% of the time, the answer was no, the bull volume was lower. And 54% of the time, the answer was yes, it was higher. This is fantastic. It gives us 2 big, balanced groups to compare, which is exactly what you want for a clean investigation. You know, the choice of your tool is absolutely critical. While Stat7a gives us this beautiful, clean split, another tool mentioned in the report, Stat7d, is basically useless. It's a dangerous oversimplification. It just throws almost 98% of all the signals into one giant, messy pile. It just goes to show you how you ask the question can be just as important as the question itself. All right, the stage is set. We've defined the myth, we've got our mountain of data, and we've chosen our detective tools. So now it's time for the big reveal. Let's see what happens when we finally let the data talk back. And here it is. Brace yourself. When the bullish volume was less than the bearish volume, the complete opposite of what the myth tells us, the data clearly points to a buy-only outcome. But when the bullish volume was greater, confirming the move, the dominant outcome was actually a sell. Yeah, let that sink in for a minute. Stronger volume actually led to a weaker or even a reversed signal. This flips the common wisdom completely on its head. So what on earth could be going on here? Well, one potential explanation is that this strong volume isn't conviction at all. It's exhaustion. It could be that last desperate wave of retail buyers piling in right as the big players are quietly selling to them. And just in case you're thinking this is some kind of fluke, it's not. Remember our detailed witness Stat7? It tells the exact same story. Look here. One of the single biggest groups in the whole dataset, with over 1,200 signals where volume was lower, is classified as buy only. But then you look at the single largest group of them all, making up over 30% of our entire dataset. That's 1,643 signals where the volume was strong and the model's conclusion was sell only. This isn't just random noise, folks. This is a powerful and, frankly, shocking pattern. So, after that major plot twist, what does it all mean? Let's zoom out for a second and look at the bigger picture, because this is about way more than just one candlestick pattern. It's really about how we should think about market wisdom in general. Now, this is really important, and it's a quote that comes directly from the source report. This analysis is being presented as powerful, practical evidence, not as formal academic proof. The way to think about it is that we've just generated a brand new hypothesis, one that directly challenges that old myth we all thought was true. This whole investigation also taught us a ton about our tools. For that clean, simple filter, Stat7a was the absolute star of the show. For digging into the full story, Stat7 was our go-to. And it definitely showed us the danger of oversimplifying with a tool like Stat7d. Choosing the right lens to look at the data through is just everything. So we came in, we tackled a myth, and we found some truly surprising results. But what are the big lessons here? What's the real story we should be taking away from all this data? Okay, here's the bottom line. 1. Textbook trading rules have to be tested with real data. You can't just take them as gospel. 2. A signal that looks stronger on the surface isn't always better. In fact, it might be a trap. 3. How you define and measure an idea is absolutely critical. And finally, this isn't the final word. It's the starting point for a new idea, and it shows that data can uncover some seriously counterintuitive patterns you'd never see otherwise. And that really leaves us with one last big question. If a rule as simple and as widely believed as confirming volume can be completely flipped on its head by the data, what other market rules are out there, just waiting for their own myth-busting investigation? Thanks so much for joining me for this explainer.